Yield curve analysis is a fundamental part of understanding the markets. It's possible to work out where markets move on the basis of what the yield curve is telling us at what part of the economic cycle. Or a specialist in this area is Alfonso Peccatiello. He's the founder and chief executive of the macrocompass.com. Alfonso, it's a pleasure. Thanks indeed for your time today. First of all, give us an understanding of what yield curve analysis is and what you're looking at.
Look, the bond market is always referred to as the smartest market out there, right? People look at it and they say bond traders are smarter than equity traders or stock market traders, for example. The reason why that is that the bond market is the foundation, really, of all other asset classes. When you get a mortgage from a bank, your reference rate is calculated using the bond market, for instance, as an underlying assumption. So, the bond market is a multidimensional beast, and the yield curve reflects a lot of what people expect for the short term and for the long term. And it is also a representation of different ecosystems in the bond market. So the short end will be more driven by central bank monetary policy decisions. The long end of the bond market instead will be driven by expectations about future growth and inflation that are sometimes de-anchored from what the central bank is doing right now. And that's why the yield curve can move and have different shapes, and it informs us on what is likely to happen with economic growth and inflation ahead.
Okay, looking at your paper you released recently, you attached a fascinating chart showing 4 different situations. Just explain this. We'll bring it up now to illustrate this. Explain what it is you're talking about in the context of this chart.
So, first of all, let's divide the chart into 2 areas, the left one and the right one. On the left one, you see, the top one and the bottom one. On the top side of the chart, you see flattening, and on the bottom side, you see steepening. So let's start defining what that is on a yield curve. So when the yield curve flattens, it basically means that the curve effectively is becoming flat and sometimes even inverting itself. So we have the situation today where long-dated bond yields in some cases are lower than front-end bond yields. So when the curve becomes inverted, we often hear that something is wrong about the economy. Instead, when the curve is very steep, like you see in the bottom side of the picture there, it means that markets are expecting positive growth and positive inflation ahead. The economic cycle looks good going forward. So that's the first thing you should understand. Flat curves or inverted curves are a signal of people expecting lower economic growth and inflation ahead. Steeper curves are instead a signal that people expect more rosy growth ahead. Now, let's first define why that is the case. So when the curve is flat or inverted, what does it mean? It means that the central bank is keeping interest rates at the front end very high, very restrictive in a way that is hurting economic growth and inflation down the road. Economic growth and inflation are the main drivers of long-dated bond yields. So take today. Today in the US, we have T-bills, 6 months, 1-year interest rates at 5%. But the market is expecting that long-term future growth and inflation will come down as the result of this very tight policy by the Federal Reserve. This slowdown is reflected into 30-year bond yields, which are lower than the 5% I talked about before. So the market is expecting that the Federal Reserve will do damage to the economy by keeping rates very high, and it's reflecting that into an inverted yield curve. Now,
okay. I was going to say let's just pick up on a couple of points there, because I think it's important to understand the length of time we're talking about here in the yield curve. When you talk about the steepening and the flattening and the inversion, over what period are we talking about across the bond markets? Because as you said, we have bond markets that have yields that represent very short-term interest rates, and we have yields that represent very long interest rates. Typically, what are we looking at in terms of the dates at either end of the curve?
So the central bank has a lot of influence on what's called the short end of the yield curve, and that's between 0 and 5 years. Anything above that, especially 10 to 30-year interest rates, are not driven by the central bank itself. They're driven much more by growth and inflation, expectations of future growth and inflation over the next 10 years, 30 years. And that's why today, as you get the central banks hiking interest rates to fight inflation, you get front-end interest rates moving higher. They reflect this tighter policy from central banks. But the bond market is telling you on the long end, on 10-year, 30-year bond yields, that this is not something sustainable, that by hiking interest rates that much now, they are inverting the curve and they're expecting growth and inflation to moderate and come down pretty aggressively over the near future. This is also why we always say that an inverted yield curve predicts a recession. Because by keeping interest rates that high, the bond market at the front end, the bond market is telling you, you are going to do damage to the economy. Borrowers are going to feel the pain. In the UK, the mortgage market is somehow frozen. People cannot afford refinancing their mortgages at these high mortgage rates. So what happens is they pull back. They pull back on housing activity. They pull back on economic activity. And this feeds into a recession. And the bond market expects that. And it tends to price it out on the long end of the bond market, expecting lower future growth and inflation, lower yields, and hence an inverted yield curve.
So that's a very clear understanding about what's happening. Let's apply what you've been talking about there to the current situation. How do you read what's happening in the markets at the moment, where this yield curve is? How is the yield curve looking to you at the moment, and what is it implying?
So we had, looking at the chart that I tried to describe before, we had for most of 2022 what would be called the top right bear flattening. So the blue curve was the beginning of 2022, and the orange dotted curve is where we ended the year, which meant front-end interest rates were hiked really aggressively by central banks. That's a red dot that goes up very, very fast on the top right, but the curve became flatter. So basically, investors said, okay, I understand that the central bank is hiking interest rates very rapidly. I will reflect that into 2-year interest rates that move up a lot. But at the long end of the curve, I'm not going to reflect this too aggressively because I expect that the recession will be coming as a result of this tighter monetary policy. We have now transitioned in the shape of the yield curve to the bottom left. That's called bull steepening. And this transition between the bear flattening on the top right and the bull steepening, where people start to challenge the central bank, where front-end interest rates, look at the green line on the bottom left part of the graphics, where front-end yields start to decline again, and people challenge the central banks and they say, we don't believe you. We see that the recession is coming. We see recessionary signs here, and we expect you to be forced to cut interest rates very, very soon. It's when this transition happens that very often in history, damage has already been done to the economy. We are transitioning to the point where we don't expect a recession anymore. We are effectively already going into it very soon. The bond market smells it, and it reprices lower front-end yields because it wants to send a signal to central banks that they will need to cut interest rates very soon. This is where we are, especially in the US, because they're more advanced in the cycle. But I guess this is where we will be as well in Europe and in the UK in the second half of the year.
Okay. In a typical cycle, does the yield curve inversion happen slowly and the correction fast? Or
that's right.
Is there an equal balance on both sides?
You're totally right. Very smart question. The bear flattening that we saw of the yield curve in 2022 happened slowly but surely. We had this curve relentlessly flattening month after month. The steepening, though, that we have seen recently, where the front-end bond yields get repriced very rapidly all the way down, it happened really rapidly, didn't it? Especially with the banking crisis in March, where we saw front-end interest rates moving down by over 100 basis points in a few weeks. And why does it happen so rapidly? Because while we prepare for a recession, we price it in slowly but surely, when recessionary episodes, credit crunch, credit contractions tend to happen, they happen really quick. And so this transition tends to be very abrupt. And also the rotations in the equity markets that go along with this transition can be very abrupt as well.
Okay, so let's now apply this to the way you view the markets. What are the markets we should be looking at to trade, given where we are with your yield curve analysis?
So look, let's start from the equity market. When you transition from the curve flattening and anticipating a recession into the curve steepening, which means we are getting really close to the point where the Federal Reserve has to cut interest rates, you have two situations unfolding. The first is generally a short period of market euphoria. This is counterintuitive, isn't it? But the market has been instructed for the last 10 years to act happy when the Fed is pivoting. When the Fed is doing a pivot and is loosening monetary policy, markets are supposed to chase that and to buy the dip. This is how we have been basically instructed to act over the last 10 years. So when that happens, what the market tends to do is, wow, interest rates are coming down. That's good for the stock market, isn't it? So they go and buy NASDAQ, tech stocks, high beta, strong market momentum and sentiment type of stocks, right? Like tech stocks, for example. And that's what we have seen recently. The problem is that if you look a bit further, the reason why interest rates are going down, the reason why the market expects cut, the reason why the curve is bull steepening, is because we are entering a recession. So don't forget that part, because earnings will be coming down. And when earnings come down, there is nothing to be very happy about the stock market. So in other words, we enter the second leg of the bear market, which is not the valuation-driven one, but the earnings-driven one. So earnings start to come down, sentiment becomes negative again. And it's in that leg where generally the stock market tends to reach its bottom. So when it comes to the S&P 500, for example, I still expect it to retest its lows, but first we're going to have some euphoria, right? So we have a period where people see only the positives of having lower interest rates, and only later they realize, why are we having lower interest rates, which is an earnings recession, which gets reflected into lower stock prices. When it comes to sectors, in that paradigm, it's defensive equity markets that perform the best. Consumer staples, utilities, healthcare, they tend to do much better because they are less cyclical in nature than aggressive sectors like industrials or cyclicals, or the tech side of the market.
Can I just quickly interrupt you there as well? Very briefly, talk about the S&P 500, talk about testing the lows. Are you talking about the lows that we saw back in October last year? Or are you talking about the COVID lows down at 2184 back in 2020?
I'm talking about the 3650 that we saw in October 22. So the reason why I don't think the stock market will go much below that is because the stock market never bottoms when earnings bottom. So what we're discussing now is earnings being degraded in the second half of the year due to a recession. But at that point, the Federal Reserve would have already released its pressure on markets by at least 3 to 6 months. So you have the valuations basically that can slowly expand again, because the market understands the Federal Reserve isn't tightening anymore. So valuations tend to flatline or increase a bit, even as earnings are coming down. So the lows will be tested when earnings really take a big beating, and the Federal Reserve is still a bit stubborn, doesn't want to ease monetary policy yet. That's exactly when I think the lows are going to be retested. But I don't think the S&P will trade again at 3,000, to be honest. There will be, I think 3,600 is a fair number.
Yeah. Just very quickly, what happens to the dollar? We're talking here about the US bond markets. I think they're the biggest bond markets in the world. Talking about your analysis there, how should we read the dollar, bearing in mind where we are on the yield curve, the positioning we are on the yield curve at the moment?
Look, short term, I think the euro, the sterling will still do pretty well against the dollar. And the reason is that the macro cycle in the US is more mature than it is in Europe and in the UK, which means the Federal Reserve will be called to ease earlier than the ECB and the Bank of England, which has a negative impact on the dollar and a positive impact on the euro and the sterling. This is the short term. If I look forward, what happens in a recession is generally we have some credit stress. We have stress in the system somewhere, be it the housing market, being the commercial real estate market, being the banking sector. When you have these episodes of stress, normally you have deleveraging and bad sentiment, and the dollar tends to benefit from it. So short term, over the next 1 to 2 months, I expect the dollar to depreciate a bit further, but I wouldn't be looking for this trend to continue. At that point, I'd rather be looking to accumulate some dollars against a deleveraging or a credit stress event in the system.
Look, it's been an absolute pleasure talking to you about this, and it's great to get your analysis on how we should read these changes in the yield curve. Alfonso, thanks for your time.
Thank you very much.
That's Alfonso Peccatiello. He's the founder and chief executive of the macrocompass.com. If you want more information, do email Alfonso at info@themacrocompass.com. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.